Hey, how's it going? Bryant here. So today we're going to talk about, in my series, Bryant To Economics, we're going to talk about mortgages. Disclaimer, not financial advice. Don't listen to me. I'm not a mortgage. I'm not licensed to do anything. I'm not a broker or anything like that. Like I'm not a professional right now. All right. I'm not an active professional. So this is not meant for financial advice. This is meant for only for like education purposes, if that, probably just entertainment, but I want to give you an idea. And I don't want business, okay? This is only to teach you guys stuff that I kind of know ish, to help you guys make as educated decisions as possible. So basically the topic is mortgages, particularly conventional loans. So we're talking about typically one family. Let's talk about one family homes and mortgages, okay? Slash mortgages. What do banks, and part of my handwriting, I know it's terrible. What do banks look for when you're getting a loan in the state of New York? Typically in the state of New York, when you look for a loan or mortgage or whatever it is for one family home, but this applies across the board. Conventional meaning this loan checks your income, checks your credit, checks your assets, and it's typically 10 to 30 years long. And if I'm mistaken or wrong about anything, forgive me, I'm an idiot. So let's say you want a 30-year loan. And it's going to be fixed interest. What this means is that your principal and interest payments every month always stay the same. Okay, so you'll never get a surprise. So we're going to focus particularly on fixed rate loans. So basically, what are the components of a mortgage that you pay? You pay principal, which is the balance of the loan. Like you borrow $500,000, your principal is $500,000. Your interest over 30 years might be $1 million. So you might pay, depending on the interest rate, $1 million in interest for a loan amount of $500,000. I know it's scary. That's just how it is. So your loan, you might have $500K borrowed, and at the end of it, you might pay like $700,000 in interest over 30 years, something like that. And this, talk to your own, loan officer, your own professional, your own whoever that knows it. But that's the gist of principal and interest. So the longer the interest term is, if it's 30 years, the higher the interest rate, the greater the number of interest payment you'll be paying for the loan. Then you have taxes and insurance. So taxes, typically property taxes, whatever New York State says you have to pay per year. And then you have your homeowner's insurance in case there's a fire, building burns down, and the cost of repairing it, or you have a flood or whatever it is, or someone breaks into your house or something happens. So basically, long story short, something happens to the property, insurance covers it. And then that has other components. Well, that will ensure at least the value of rebuilding the house or something to that effect. So you basically have, the main thing is PITI, which is typically when you get a mortgage, it's a monthly payment. So your monthly payment composes of PITI, your principal, your interest, your taxes, and insurance. So that's basically, yeah, you go to the bank, you don't have the money, you go to the bank, and the interest rate might be really, really low. It might make sense because why do people get a mortgage? Well, one, they can't buy the house without one. Or two, even if they can, it might make more financial sense for them to get a mortgage because if, let's say, they have investments, or businesses, or life, whatever it is, and the investments pay like 20% a year return on their capital, and their mortgage is like 3% return on capital, they'd rather get the mortgage because 17%, they'll pocket that difference of 17%. Or they have a business that they need to feed, or a life event like they got to pay for college or something. So there are many reasons to get a mortgage, and that's basically that part. So we're talking conventional loan, fixed rate. What do the bank typically look for, right? When you go to like any lender, legitimate lender, you have to make sure that they're part of NMLS. So it's like National Multiple mortgage listing, something. I forgot what this stands for off the top of my head. Long story short, there's a national registry ever since 2008. And the mortgage crisis happened. Then it screwed up a lot of people. There was all this fraud and people stealing social security numbers and doing fake loans that people couldn't qualify for the loan and this and that. So the government had to do something about that. So they created NMLS, and everyone that's doing mortgages needs to be licensed in NMLS if they're doing it and they're getting paid for it. Something to that effect. So, and then they have to pass a background check and all that good stuff, because you have to make sure that you're safe. So if you're dealing with it, I recommend going to a lender that's actually legitimate, like a big name lender. I'm not going to name lenders, but make sure that they have an NMLS number, because this is super, super important. Without this, I'm pretty sure they can't do mortgages. So typically there'll probably be a loan application. So there'll probably be an application, and they'll ask for the following docs. They're going to ask you for your name. So like driver's license, your ID, social security number. They'll ask you where you live, what you're buying, the address. They're going to ask you for 2 years tax returns, probably 2 to 3 months of bank statements, credit report, most recent pay stubs. Then they're going to ask you your down payment, typically 20%, give or take. But remember, when you put a down payment of 20%, if the home is let's say $100,000, example, $100,000, you put 20%, that's $20,000. You also have to factor in for about 5% closing costs. So you're really paying $125,000 for a house that costs $100,000. So correction, no, you're paying $105,000. My bad, not $125,000. You have to come up with $25,000, but you're paying $105,000 because there's going to be like a 3 to 5% closing cost depending on how much money you're putting down, concessions, and so on and so forth. So basically, your name, your driver's license, your ID, social security number. They're going to run your credit report. They're going to ask your residential history, where you live now, whether you rent or you own it. They're going to ask you what you're buying, the address of the property, whether it's a one family, it's a co-op, a condo, it's a 2-family, 3-family, 4-family, or they're going to typically ask you for 2 years of tax return. They're going to ask you 2 years job history, 2 years job history, like your history of employment. They want to make sure you have stable, like a job, and they're going to ask you for 2 to 3 months of bank statements to make sure you have money to actually pay for this, or your investment accounts or something like that. Credit report, because they want to know whether or not you have good credit, excellent credit, bad credit. Recent pay stubs to see how much you make per month, and then what you're putting down, and then how much the property costs. So this is basically all the loan officers, more or less. I'm pretty sure they're going to ask for all of this up front, and then I'm going to go into detail as to what everything sort of means. So you're going to do. So I'm going to talk about the criteria that they judge. Okay. So criteria they judge. Part of my crappy English, I'm trying to do this quickly. So equal housing opportunity, equal loan opportunity, very important. They cannot discriminate against race, creed, color, religion, so on and so forth. Any protected class, okay? You cannot. The only thing that you can determine, legally speaking, whether or not someone can get a loan is based on job history, credit, down payment, like that kind of stuff, like numbers. So let's talk about credit. So typically, credit, it runs from a score of like 350 or 300 to 850. Typically, 740 and up is considered excellent. 720 and up is good. Like 700 is kind of like good minus, like a good minus, and then like a 650 is like fair, and then everything under for conventional is like fair, poor, bad, something like you typically want. Like nowadays, I think it's like, again, I'm not a financial advisor. I don't know what I'm talking about. Don't listen to me. You can shut off this video. Basically, I think they want like 720 and up or 700 and up at least, because you typically want good credit. And what does that comprise of? Your payment history, your debt to income, like your loan balances. They want to make sure that like you don't have a credit card with like $10,000, like a limit, and then you owe $9,999 owed. This is bad. This is bad. So you don't want this, and you don't want missed payments. You want preferably no missed payments, because missed payments will stay on your credit report for about 7 years or more. But typically, you don't want any missed payments, because that's going to really hurt you. Like your score is going to drop a lot per missed payment, especially if it's recent. So you don't. These are things that you don't want, and you typically want to show some trade lines, like 4 trade lines. Where a trade line is like car loan, credit cards. You might have a loan for appliance, furniture, so on and so forth. So you typically want 4 trade lines, typically, and that comes from having, like, if you have 4 credit cards, then that's like 4 trade lines. Remember, the bank, they want to lend money because that's how they make money. They don't make money if they don't lend it. What else am I missing? So basically, and then like the length of history, right? So they want like a 2-year length, give or take. And then if not, some lenders, they'll like find other ways to do it. But again, every lender's slightly different. But this is the gist of the credit aspect of it. And then if, let's say, they also care about what's your total monthly minimum payments. So if, let's say, you make every month, you make $5,000 a month gross, and your credit card payments or all your bill payments are like $4,000, like that's already like 80% debt to income ratio, then like it's probably not going to work. So that's the credit aspect. So then let's talk about something called DTI, which is very important, which is called your debt to income ratio. Debt to income ratio. What this means is, let's say you have no credit. I mean, you owe no debt on your credit report. You owe nobody. This is you're only going to pay the mortgage, right? So if the mortgage payment is $2,000 a month, which is your PITI, we're going back to our principal, interest, tax, and insurance. Your total monthly mortgage payment is $2,000, and you make let's say $5,000 a month before taxes. This is your gross. Okay, this is before tax. Then your DTI is 2 over 2,000 over 5,000, so equals 40%. So you're basically 40% DTI. So you basically, I think the maximum they give you is like, you want it to be under 45%. But then there's 2 criteria. Like there's DTI that's including all debt together, or housing alone. So the DTI, you may or may not qualify for the loan depending on the lender. But typically, like, let's say if their housing DTI is 33%, then if your mortgage payment is $3,300 a month, this is your PITI, your PITI, then every month you have to make $10,000. Because you cannot go above the debt to income ratio or the home to income ratio that the bank sets. So if, let's say, the lender has 33% home to income ratio, that means the mortgage payment, if you make $10,000 before tax, the gross payment, the loan payment cannot be more than, and this is for one family house. We're only talking about one family house here. Cannot be above $3,300 PITI. And let's say you have a car payment and you have credit card payments and student loan payments, and all those payments added together is another $1,200. Then you can have up to $4,500 in loan payments a month, DTI, which puts you at 45%, which will qualify you for the loan. So again, if you have the DTI, which is the debt to income, you don't want to exceed what the lender, because you still have to be able to eat, enjoy life, and do stuff, right? So the lender doesn't want the loan payment to be so high that it's considered a risk, because then you can't save any money. How do you eat? How do you pay for transportation? How do you pay for utilities? How do you pay for repairs? So these are the things that they consider. So in an ideal scenario, you don't want the DTI to be above 33% in terms of the home. And then they don't want the DTI, meaning the total of all debt with credit, student loans, and every other loans, to be above 45%. So that takes care of how they consider your debt to income ratio. And then comes the how they calculate mortgages. Okay, so let's talk about how they calculate mortgage payments. So if, let's say, you have 3% interest and the property is $100,000, and let's say you're borrowing $100,000, then your 3% interest is going to cost you $3,000 a year in interest. So you divide this by 12 or whatever. That means every year you're going to be paying $3,000 a month in interest, and then you do you can use something like a mortgage calculator to calculate what the payments are over 30 years. They have them all over Google. But basically, long story short, you have to understand that when you pay for a mortgage over time, the initial mortgage payments will be basically based on your interest. You'll be paying interest heavy, and then over time you're going to be paying more principal heavy. So, and then they'll look for things like your job history. Have you been on yeah, I think that about covers it. If you put down, then there's the limit of like the appraisal. So, that's the other thing that I wanted to make sure that I covered. So let's say you want to buy a house for $500,000, and then you go to the bank for a loan. They're going to have an appraiser, so they're going to do an appraisal. So you're probably going to pay for that. So the appraiser is going to come in and tell you, based on all the properties in the area, whether or not they think that this property is worth $500,000. For example, if the appraiser comes and says that the property is only worth $100,000, then and they want 20% down, that means the bank is only going to loan you $80,000. So it's very important to make sure that the property gets appraised at the value that you're buying it for, or close, because if the appraiser comes in short, the bank won't lend you as much because of the risk. And then you want to check for housing violations, survey. You want to check the violations. You want to do the survey. You want to do the home inspection to make sure that the property you're buying is structurally sound, and then there's no violations like is it a one family home, and then they added like 10 more kitchens and bathrooms, and then that's going to be a violation, and then the bank's not going to lend on that because there's like illegal conversions, or is there like a garage that shouldn't be there. And in the survey, you want to make sure that plot of land, you actually get how the size of the land that you buy. And then there's the title insurance. So the title insurance, when you buy a home from somebody, you want to make sure that they own the home outright, and that the bankruptcy court or tax court or liens or heirs, no one's going to contest or dispute whether or not that person owns the property. Because if you buy a property from someone and they don't really own it, then you're gonna be paying for nothing, because you're gonna have to go to court and so on and so forth. So that's the quick run through of buying a conventional one family house. Let me know if you have any questions, and then like, subscribe, and let me know.